How do you steal over $1 billion from a banking system? You don't need explosives, a crew of safecrackers, or a getaway chopper. In 1992, one man executed the largest heist in Indian history, using nothing but a typewriter and blank pieces of paper. In the early 1990s, India's economy was waking up from decades of heavy regulation. The government was opening the doors to global markets, and down on Dalal Street, the financial sector was hungry for rapid growth. Before digital algorithms and internet brokers, the Bombay Stock Exchange was a physical battleground. It was a loud, chaotic trading floor driven by screaming brokers, hand signals, and raw momentum. Standing at the center of this chaos was Harshad Mehta. He wasn't old money. He started as a small-time broker, but he moved stocks with such violent upward force that the middle class began following his every trade. They called him the Big Bull. Mehta seemed to have a Midas touch. He pumped massive capital into specific companies, dragging the rest of the market up with him. He targeted a cement company called ACC, driving its share price from a modest 200 rupees all the way to an impossible 9,000 rupees in a matter of months. His wealth became legendary. He ruled from a 15,000 square foot sea-facing penthouse in Mumbai and owned a fleet of imported luxury cars. At the center of it all was a gleaming Toyota Lexus. In reality, they were watching a man exploit a broken system to execute a highly coordinated, illegal siphon of public funds. To understand the exploit, look at the strict rules the banks had to follow. By law, Indian banks had to maintain a specific ratio of their assets in government bonds. To manage their daily cash flow, banks constantly traded these bonds back and forth with each other in short-term loans called ready-forward deals. Moving physical government bonds across the city for a short-term trade was incredibly inefficient. So the banks used a middleman, a broker, to coordinate the deals and ferry the paperwork between Bank A and Bank B. Here is where the entire system falls apart. Because moving the physical bonds was tedious, the banks stopped asking for them. Instead, a borrowing bank would simply hand over a bank receipt, a literal piece of paper confirming they held the bond in their vault. The lending bank would hand over billions in cash in exchange for this flimsy IOU. There was no central ledger, there was no digital verification. The liquidity of the entire Indian banking sector was running on an unverified honor system. Mehta found the weak point and broke it wide open. He colluded with smaller, less scrutinized banks and had them start printing completely fake bank receipts for government bonds that simply did not exist. He took these forged IOUs to the major banks. Blinded by the established trust in the paper receipts, the large banks handed Mehta thousands of crores in unsecured, untraceable cash. As the middleman, Mehta was supposed to deliver this money to the borrowing bank. Instead, he took the cash and pumped it straight into Dalal Street. He aggressively bought up shares, creating intense upward momentum that forced everyone else to buy in. The legendary bull run of 1992 was a complete mirage, artificially inflated by a continuous fire hose of stolen bank capital. But every Ponzi scheme requires a constant influx of cash to survive, and Mehta was becoming dangerously conspicuous. The math behind his lifestyle was breaking down. Standard broker commissions simply could not pay for a fleet of imported luxury cars. Sucheta Dalal, an investigative journalist for the Times of India, saw right through the big bull Masalji. She looked at the Lexus, looked at the market liquidity, and realized the numbers were completely detached from reality. In April 1992, Dalal published a devastating exposé. She mapped out the fake bank receipts and revealed a 5,000 crore rupee hole, roughly $1.2 billion, right in the center of the banking system. The revelation caused instant panic. The stock market went into an immediate freefall. When the major banks scrambled to recall their loans, they realized the horrifying truth. The money wasn't sitting in a vault. It simply vanished into the financial ether as stock prices plummeted. The massive bubble burst, leaving behind thousands of worthless fake receipts and wiping out the life savings of millions of middle-class retail investors who had followed Mehta's lead. The sheer terror of this massive liquidity drain forced the Indian government into immediate action. They had to completely tear down and rebuild their financial architecture to ensure a paper-based heist could never happen again. The country rapidly transitioned to modern electronic trading, creating the National Stock Exchange to eliminate the blind spots of physical paper. The government also weaponized the Securities and Exchange Board of India, turning it from a passive observer into a ruthless regulator. Harshad Mehta's empire was seized, and he spent the rest of his life tangled in endless litigation. He died in 2001 while still on trial, leaving behind a highly polarizing legacy. To an entire generation, he looked like a champion, a man who finally outsmarted an elite, closed-off system and let regular people win. But in the end, the common man's hero ultimately engineered their greatest ruin.